got the recorder going, so we are going to discuss CREE. Can everybody hear me okay? And I don't want to bore anybody, but I'm going to start from the beginning again as a review to what we did with CREE. All right, going back to the original signal. Okay. Whiteboard, let's move on here from the VIX. And here you can see we did an evaluation, what is this, about 10 days ago. Okay, so you know what, let's make this CREE evaluation part 2. 4/8/19 CREE evaluation part 2. Okay. If anybody that is not in this, if you have questions along the way as I'm putting info up here on the whiteboard, just let me know. Okay, so we originally bought the April 18th, 57, 59.5 call spread, and we paid 70 cents. Okay, that was the start. And again, remember we had some of us had two positions in CREE. We had a call calendar spread, and then we had this vertical spread. I'm only focusing right now, guys, on the vertical spread since that's what we have that turned into a butterfly. Okay, so just a couple days later, after we bought this thing, we sent out an exit signal. We sold half at $1.30 or more. Okay, so we're left with half our position there. We did that obviously just for risk purposes, right? We need to be risk managers as well. Why not take off some of that for a very, very nice profit? Okay, then we could have, at the time, we could have done what? So we're left with half the position. We made a decision to turn this into a butterfly, which I'm going to explain in a moment why we did that. But what else could we have done with the remainder of our long position that we had in there? Okay, Finley, I'm not sure what we would have rolled to. Yeah, we could have put a stop. Exactly. We could have just put a stop in for the balance. Okay, that would have been certainly a choice, and we do that very often. The reason we decided to turn this into a butterfly was twofold. Okay, anybody remember? Anybody want to give me one of the reasons? Okay, great. You got it. Free. What does Michael mean by free? What does Michael mean by free, everybody? We were able to sell, exactly. So we were able to sell the upside part of the butterfly here. So the 59.5, 62. Remember, we had a $2.50 wide call spread on to begin with. So then we sold a $2.50 wide call spread for the same amount that we bought the original spread. Okay, so at a minimum, Beautiful, David. So you sold it for even more. But at a minimum, we were able to get in this butterfly for free. It literally was a free trade, meaning that no matter what happens to the stock, whether the stock would go to 0 or whether the stock would go to 100, no matter what would happen, we could not lose. We profited, we pocketed the money on the first half that we had exited, and on the remainder of our spread, we're locked in, could not lose, could only have upside on it. Okay, the other reason we chose to do this, anybody remember the other reason? Number one, which Michael said, the freebie reason was really probably the most important one, but the other one definitely played a hand in it as well. Well, yeah, fantastic. That all goes into, Raymond, that all goes into this being free. So the reward to risk was, yeah, over the moon great. But the second reason was, when we did this, okay, when we did this, the expected move in CREE when we did this was up to about 60 on the upside. At the time we evaluated this, I don't remember exactly what the expected move was, but I remember that, you know, let's say it was $2 or, you know, whatever it was, that put it to the range of 60. Well, great. If CREE winds up at 60 at expiration, man, oh man, that's you know, almost the bullseye. Obviously, it has rallied well beyond that. So if we were just using, in hindsight, if we were just using that trailing stop, man, we'd probably be out of it by now. But God, we would have, just kept raising and raising and raising that trailing stop, and obviously done extremely well. Okay. But these were the two reasons that we decided to turn this into a butterfly, a free, no risk position. Okay, everybody with me so far? Because now I want to get into the actual mechanics, the delta, the Greeks of how this spread will work between now and expiration. Okay, cool. So right now we have the 57, 59 and a half, 62 call butterfly. And as you guys always hear me say, we always want stock to go to the short strike. Okay, well, the short strike here, which we're short 2 of them because it's a butterfly, is the 59 and a half strike. So if we go to 59 and a half at expiration, okay, think about it this way. If we are at 59 and a half at expiration in the stock, then the 57, 59 and a half call spread part will max out at $2.50, and the 59 and a half, 62 will be worth bupkis, a goose egg, for a max value of the butterfly of $2.50. Okay, everybody get that concept? And again, this is why this is proof from a dollar standpoint, from a dollar, not a Greek standpoint. We're going to get into that in a moment, but from a dollar standpoint, why we always want a stock to move to our short strike. Okay. So let's see what this thing is trading currently. Okay. The butterfly, and we know one of the unique properties of a butterfly spread, a true butterfly, not a skewed or what we call a broken wing butterfly, but one of the properties of a butterfly is that typically doesn't change in value quickly at all unless one of two things happens. Unless we get a huge move in the stock, just beyond all strikes, one way or the other, or until we get closer and closer to expiration. And we're still almost 2 weeks out. Okay, so this butterfly is really trading about 40 cents today. And remember, we're in this for free, right? We're in it for free, right? Okay, so currently, the butterfly is 40 cents. And that's probably not going to change much, at least over the next 2-3 days, unless there's a massive move in the stock, one way or the other. Okay, so here's how the Greeks or deltas start to play into it. Okay, here's how the Greeks start to play into it. If we look at the overall delta of the spread, okay, you can see we're short delta. Not a lot, but we're short delta here, short 10 delta. That just automatically tells you that, if anything, we want stock to go down. We'll make money as the stock goes down. Okay, now, let's say that we were going to fast forward. We could fast forward in time between now and let's say a week from Wednesday. And remember, guys, expiration next week because of Good Friday. The last day to trade is actually on Thursday. Expiration will still be on Saturday, but last day to trade is Thursday. So that's going to be the close of where everything really, quote unquote, expires. So let's say we were able to fast forward ahead to next Thursday. If CREE was still trading right here at 61.93 or 62, what would this delta be? Anybody? Okay. Joe says 0. Anyone else? Come on, don't be afraid. Don't be afraid. Okay, sure you do, Chris. I bet if you thought it out, you would absolutely know the answer to this. Anyone else? The question was, Raymond, if we were now next Thursday, so basically at expiration, and CREE was in the same place here, 62 or 61.95, wherever it is, what would the delta of our butterfly be? Okay. Good. I'm glad we got lots of different answers now. Okay, so Raymond and Gary, those of you that are saying 50, tell me why 50. Let's talk through this. What could go up or down, Raymond? David, hang on to that thought for a second. Okay, so Gary, I think you're thinking about this a little too much and a little bit backwards, but let's take a look here. Okay. If we are at expiration day and the stock is 61.90, what is the delta of the butterfly? Okay, well, the delta of the 57 call is going to be 100, right? The delta of the 59.5 calls are 100 each. Remember, we have 2 of them, but we're short those. The delta of the 62 call, guys, with the stock at 61.90 is going to be what? Thank you, Joe. David? Okay, so if this is the case with the stock at 61.90, we're actually net short about 100 delta, right? Which would seem like, oh my God, that's an incredibly risky position to be short 100 delta right at expiration, right? I mean, in theory, that's true. However, this is why I'm teaching you guys to look at it this way. Okay, is everybody following along? Is everybody following along? Because if you're not, that's okay. I'll go back a step or two. Okay, so everybody sees here that at 61.90, we're actually short 100 delta, right? Okay, let me get the new whiteboard up here. Okay, 4.819 CREE part 2, page 2. Okay. Okay, Michael, before I move on, what part of it don't you understand yet? Which part of this don't you understand? So Todd, if you look at it, our 57 call, which we are long, well, because it's in the money, Michael, right? If the stock is up at 62 and we own a 57 call, it's at expiration. It's in the money. It's going to be exercised and turn into stock. So it's 100 delta. Same with the 59.5 calls, Todd. Those are also going to be exercised because they're in the money at expiration. So they're 100 delta. But remember, we're short 2 of those. So we're long 100 and then short 100 twice for a net short of 100, while the 62 call has 0 delta because it's out of the money. So Michael, does that make sense why those are 100 deltas? Remember, they're going to turn into stock. So that's how to think of it, that they're 100 delta. They're really stock. They're going to be exercised. Okay, great. So that's why we're going through this. Yeah, even if the stock was 57.10, Michael. Now remember, we're talking about at expiration. We're not talking about today or tomorrow. We're talking about at expiration. Yes, if they were in the money, they would be 100 delta. Even if the stock was 57.02. Okay. All right, so let's continue this now. However, so actually, let me go back to this point here. So at 61.90, we have short 100 delta, big risk, right? Or not. Ordinarily, I'd say yes. But why is it that it's really not? Okay, David? Which lower long strike are you referring to, Gary? Are you talking, when you say lower, are you talking about the 57 or are you talking about the upper one at 62? Well, we already have that. We already have that factored in here. Gary, let's go back on the whiteboard here. Down here at the bottom, we have the 57 call. So that's 100 delta. But we're short 2 of the 59 and a halves. So it's the mathematical equation here, if we just kind of put this out, would be plus 100 minus 100 minus 100. Right? 100 for our long option, and then short 100 each for the 2 short options that we have. Todd, let's not step ahead here. Let's not step ahead. Okay, I want to make sure. No, don't be sorry. That's fine. Don't be sorry. I want to make sure that everybody is on with this and is understanding before we move on to the next point I'm going to make. Very important. Very important to think about this. This is one of those times, you know, I say quite often that you want to be like a point guard or a quarterback. You want to be able to see the whole field. So you want to be able to see, okay, this option is, you know, is going to act like this today, but how's it going to act tomorrow, or how's it going to act at expiration? And this is what I'm trying to get you guys to understand here, to see the vision here. Bob, I got your emails, man. I'm in the middle of explaining this here. I got your emails, and I'll respond to them. Thank you. I will definitely get to them. Okay. So we have this 100 short delta position here. Big, big risk. There you go. David just hit the nail on the head. We are also long the 62 call. And that's what makes the butterfly happen. That's what eliminates and reduces all of the risk. Because all of a sudden, if the stock goes up 11 cents, let's say, to 62.01, the delta of our 62 call all of a sudden goes from 0 to 100. And that's where we are protected. So all of a sudden, our entire butterfly spread goes from short 100 deltas to being flat delta, 0 delta. Okay, so really, what this comes down to then is any price below 62 down to 59 and a half from now until expiration will result in a short delta position. And a gain, Russell, that's correct, and a gain, but a short delta position. Okay, and why is that? Why is that? Again, I put something out there, so I want you guys to now understand why that is. Anybody have an answer for that? Okay, but what about the fact, Joe, that we're short 2 calls? That definitely leads up to the answer, but why is it? Okay, so the 62 is out of the money, so that's a zero delta, so that doesn't even factor into the equation, Bob. Okay, that's right. So why then, if we're only focusing now on the 57 and the 59 and a half, why would we be short delta from 62 down to 59 and a half? Okay. Short delta because no matter what, in this scenario of 62 down to 59 and a half, the 57 call will be what? How many delta? Okay, good. Okay, perfect. Now, what are the deltas of the 59 and a half going to be, depending on this range of the stock? Okay, the delta of the 59 and a half will be between 50 and 100, right? Depending where the stock is, somewhere between, remember, 62 down to 59 and a half. The delta of that 59 and a half call is going to be 100 down to 50, right? It's going to be 100 if it's up at 62, and it's going to be 50 if it's down at 59 and a half, because it'll be right at the money, right? So at a minimum, the combined, delta of these two short calls will be at least minus 100, right? So even if they're down, even if the stock is down to 59 and a half, and that call only has a 50 delta, remember we're short two of them, that gives us that negative 100 delta. So then we would be long 100 from the 57, short 100 from the two short 59 and a half calls for a net of zero delta. Okay, so that's why I said anywhere from 62 down to 59 and a half will result in a short delta position. Michael, you're repeating what I just said. You're absolutely correct. But we're talking now if the stock is down at 59 and a half, then what is the delta? Exactly. So that puts us then at a zero delta at 59 and a half. But anything above 59 and a half, we will have short delta. Is everybody clear on that? Because I'm going to hopefully turn a light bulb on here. Okay, so we've always talked, again, about how we want a stock to go to our short strike, right? We've talked about it from a premium standpoint. Because if a stock goes to our short strike, we will max out the amount of premium in that short option, right? Well, now we're proving it from a delta standpoint. Remember, if we're short delta, short delta, short delta, we want the stock to go down. We want the stock to go down. We want the stock to go down. But at 59.5 then, now we have a neutral. We have a zero delta position. Michael, remember, we're short 2 of the 59.5s. 50 delta each. Right? So if you want to call it, it's not really a break even, but if you want to call it a neutral, zero delta, 59.5 is where we'd have that zero delta. Anything above that, up to 62, is going to be short. So from a delta perspective, that shows you then if we're short delta, we want the stock to move down, right? If you're short a stock, you want it to go down. If you're short delta, you want it to go down from a delta standpoint. Okay, everybody clear on that? Everybody understand that? Because now I want to move to the next point. Towards the short strike, exactly. So now, let's keep this rolling here. What happens from a delta perspective? Again, guys, we're only focusing on delta right now, okay? What happens from a delta perspective once the stock starts to go below the short strike? Okay, so what happens if the stock starts to go below the short strike? So we've already talked about what happens from 62 to 59.5. Now we're going to look at it. Any price below 59.5 down to 57 from now until expiration will result in a long delta position. Nope. Avi, you got it right, Michael. It's not the same, and we're going to prove this out just like we did up above here with the short delta position. Okay, any questions here? There you go, Bob. Any questions here before I flip over to the next whiteboard, next page? Okay, so let me get this going here. CREE part 2, page 3. Okay, so let me just put a little review here. At 59.5, our delta is 0 because the 57 call is 100 delta, and each 59.5 call is negative 50 delta. Okay, that's our review. That's where we got to 0, right at 59.5. Plus 100 and short 100. Right? Okay, now what starts to happen to the 57 call? Okay, so again, from 59.5 down to 57. The delta of our 57 call stays 100, right? As long as the stock is above 57, that's going to be a 100 delta option. And again, we're talking at expiration. So even if the stock is 57.05, 57.30, 58, whatever it is, that option down to 57 in the stock is going to be 100. So that remains constant. However, just as we saw the delta of the 59.5 call start reducing from 62 down to 59.5, that doesn't stop. That keeps reducing. The delta of the 59.5 calls, however, will keep decreasing. Okay? And think of it this way. Remember, we're talking about at expiration. Talking about at expiration. And as long as the stock is below 59.5 at expiration, those calls will have zero delta. Right? They'd be out of the money. Thus, giving us a long 100 delta position at expiration if stock is below 59.5. Now, why is this important from a delta standpoint? Just as, when we looked at the short delta above, well, if we're long delta, what do we want a stock to do if we're long delta? Exactly. Okay. So below, we want the stock to go up. At 59.5, we are zero delta. Right? Because each of those theoretically are 50 delta. Remember, we proved that out. So we have long 100, short 100. Above 59.5, we are actually short 100 delta. So from a delta perspective, again, that perfect spot is right at 59.5. That's where our delta is zero. We get long delta below that, so we want the stock to go up. We get short delta above that, so we want the stock to go down. And that happy medium, that perfect place, now from a premium standpoint and from a delta standpoint is the same. It's at the short strike. Peter, I'm not sure what VIX-L is, unless that's the symbol for May. They're the May 22nd expiration options. And how you doing, Peter? Okay. So, good. So if I had to draw this out, okay, on a graph here, and this was 57, and this was 59.5, and this is 62. Okay, this would be long delta here, short delta here, above 62, anything above 62 is going to be zero delta, and anything below 57 is also going to be 0 delta. Whoop, let me make that better. Hang on. Okay, so I wanted to go through this whole example, and I know it's been a long, there's been a long explanation, but that's fine. Because this is the perfect time to, again, to show you guys how that short strike, how we always talk about that short strike being the perfect place. We've now proven it from both a premium standpoint and a delta standpoint. Okay. Does that, anybody have any questions on this? Anybody? And so from a profitability standpoint then, I'm going to go off the whiteboard now, and you know that spreadsheet that we used last week, that profitability spreadsheet? We're going to do that now for CREE. And that's going to also prove out to you. That's going to bring everything together now. It's going to bring everything together to show you exactly now from a profitability standpoint why the short strike is the best place. Okay. Michael, we're using expiration because obviously before expiration, the deltas are going to vary a little bit. Gary, don't let it be frustrating. Just ask questions. Okay, I've asked about 10 times along during this explanation here. If anybody had any questions, it's okay to ask questions. If you're stumped along the way here, stop me and ask questions. That is how you will learn. Sure you do. Ask, how did you get that delta? How did you get this price? How did you come up with that? That's what you should be asking. Anything that you don't understand. However, when I put this profitability spreadsheet up on the board now, from a profit standpoint, this should make perfect sense to everybody. What delta formula are you talking about, Russell? Well, that's what a delta is. There's no formula, but the definition, or one of the definitions of delta, is that for every dollar move in the stock, the delta represents how much the value of that option is going to change. Okay, Gary, so if the stock is trading below 62, okay, and that's what we were talking about in this example when we started, right? We talked about 61.90, right? Right? Okay. And remember, we're talking about at expiration. We're not talking about today. We're not talking about tomorrow. We're talking about actually at expiration, okay? So if the stock is at 61.90, the 62 call is out of the money. That call would not be exercised because that call then, if you exercised it, would give you stock at 62. Why would you do that when you can just buy it at 61.90 in the open market? Right? That's the way to look at it. And but the key is, Gary, and maybe this is what confused you, is that we need to evaluate this at expiration. Not today, not tomorrow, where the deltas are going to be different. Does that, okay, good, good. See, Gary, you knew what to ask. I'm not going to bite your head off. I'm here to help you guys, right? No, difficult to sell, Merlin? No, we could sell this right now. Right now, it's trading 40 or 45 cents right now. We could absolutely sell this. We're just evaluating this to see, again, where the ultimate place for this is. Where's the ultimate stock price for this? But to prove out why that is. Why is the short strike of 59.5 the best place for this to be, outside of just me always telling you, well, we always want stock to go to the short strike. So this is going to prove it out from both a premium standpoint and a delta standpoint. I did have a great weekend though, Michael, but I always have great weekends. Okay, so let's do this. Let me bring this. No, see now, Michael, now you just upset the apple cart. There goes my mellowness. There goes my great morning I'm having. Oh, man. Oh, am I aggravated? You know what, guys? I'm stopping right now. I'm just kidding. Okay, so you guys should all see the spreadsheet up here on the screen that I've been working on while we were talking here, right? Okay, so here is our, yeah, see, Ken, exactly. Don't poke the bear, exactly. Okay, again here, remember that this entire example, these entire prices are at expiration, okay, like it says right here. Okay, so if the stock price is 55, what are the value of, yeah, there you go, Ken, that one's even better, I like that. If the stock price is 55, what's the value of every option in our butterfly? Anybody? Okay, Ken says 0, Joe says 0, and that is correct. Every option is going to be 0. They are all out of the money. Okay? 56, same thing, right? They're still all out of the money. 57, okay, 57, they're still really all out of the money, right? The 57 call, even though we're long it, if the stock's right there, doesn't have any value to it. No, it's not break even, Russell. Remember, we paid 70 cents. So if every option is still worth 0 at that point, it's not break even yet. Okay. However, at 57.70, the only call that would have any value is the 57, right? And it would be worth 70 cents. The other two wouldn't be worth anything. And actually, you know what, guys? What kind of mistake did I make here? Remember, I made a mistake here. Nope, not wrong direction. We didn't pay 70 cents for it. Thank you, Jules. You got it. Jules has been listening. Remember, exactly, Joe. We actually paid 0. So this P&L should never show a loss because we never paid anything for it. So it will never show a loss. Okay, at 57.70, at 58, it's going to be the same thing where there's only one option that's worth anything. At 59, same thing, there's only one option that's worth anything. 59.5, you're going to see, is going to be the money spot. Maximum value there. And you'll see that in a moment here. Because now, all of a sudden, at 60, our long call is worth 3. And Gary, everybody else, you guys following along what I'm doing with the prices here? Okay. However, now at 60, or theoretically anywhere above 59.5, but at 60, now the value of this 59.5 call is 50 cents. Remember, we're short 2 of them. So you can see right here, all of a sudden, we're going up in value, up in value, up in value. We peak out right here, and now all of a sudden, we're going to start going down in value, okay, in every scenario here. Okay, at 61, this guy's worth 4, this guy's worth $1.50. At 62, 5, 2.5, 0. And then everywhere above here, this is all still going to be 0. Because now our long 62 call is finally going to start having some value to it. Because we're finally above the strike. Todd, you're very welcome. My pleasure. Okay, so we can extrapolate this out to any price that we want. And we're going to get the same answer. So once again, think of it this way. Remember before, guys, on the whiteboard, we talked about delta. If we're below that middle strike, then we're going to be long delta. And we're long delta, look at our profitability. Our profitability is going up, 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 up until we get right there. And below the top strike of 62, remember we're short delta. Well, if we're short delta, we want stock to go down. You can see that profitability going up, up, up until we get to that center strike. Okay, so again, I know that this was really, really long-winded, and I don't know when you guys will have an opportunity to listen or review to this, but it's there for you, and I'm hoping that something like this, you're welcome, Joe, is just going to kind of bring all those pieces in, the profitability, the Greeks, they do all work together. Okay, Michael, good question. Good question, Michael. Michael asked if we paid 70 cents, okay, where would that profitability then come in? Where would the break-evens be? Well, that's my question to you, Michael. If we paid 70 cents for this, where would the break-even be? Bingo, you got it. Michael, you got it. David, yes, break even on would be 57.70. It would also be at 61.30. Okay, Robin, no. No, we should not have, because again, one of the nuances of a butterfly spread is that the value does not change very much at all day to day, unless you get a huge stock move, way above or way below all of the strikes, or until you start getting closer and closer to expiration. So even last week when this stock was rallying and the stock went to 59.5, I think the most I ever saw this butterfly trading was like 60 cents. However, what that tells you is, let's say it was trading 60 cents at the time when the stock was 59.5. What that tells you is there's $1.90 of premium still left in that butterfly, right? Because we know at expiration at 59.5, it's going to be worth $2.50. If it was only trading 60 cents at the time, that means it's got $1.90 left to go until expiration. So again, that's one of those things to remember is with butterflies, they don't move very much over time. Okay, what's our worst case? What's our worst case here, Anton? Regardless of whether it moves above the long strike or below our long strike of 57. What is the worst case scenario here? Bingo. This is why this is truly a free position, because regardless of where the stock goes, it can go to 100, it can go to 0, we cannot lose. So what we're trying to do, obviously, now, we don't have, right, you would, David, lose premium, but we don't have any. We're in it for 0. So what we're obviously trying to balance now is, okay, when is the right time and where is the right time to exit this thing? We know at expiration where the best place would be. However, what's the likelihood? What's the likelihood it's going to be right at 59.5? Probably minimal, right? So it's really a matter of, okay, we kind of have to pick our spot, and that's what I've been doing. I've been just watching the trade. It's been unbelievably bullish, obviously. In fact, I don't think there's been a down day in probably 8 or 10 days. Today is the first one. Let's watch what happens today. But again, the key is, and you're learning this, and I obviously know this from doing this for almost 30 years, that butterflies don't change in value very much day to day. So this thing has remained at this 40 to 50 cent level that we're still in right now. Okay, Jules, you got it, Robert. What would have to happen in your estimation for this to go to $1 or more before expiration? And again, before expiration, do you mean an hour before expiration, a day before, 5 days before? Okay, but right now, regardless of the time, regardless of whether it's today, tomorrow, next week, what do we want the stock to do? Come back down to Yes, short strike. The more that the stock trades around that short strike area, the longer it trades at that short strike area, the better off we are. Okay, and David, we're not going to put out anything now. Okay, we're not going to put out anything right now because the stock could go to 58 and we'd still be looking tremendous on this thing. At 58, my guess is this thing is probably trading $1.20. At 60, same thing. At 60 or 60 and a half, this thing's going to be trading 70, 80 cents. Okay? So again, until we start getting a massive outlying move and start to see the value of this dwindle down, or if we start to get a little bit closer to expiration and see that value dwindle down, we're not getting out of this yet. However, realistically, okay, we have to be realistic with our goals and our expectations, okay? Realistically, we're not exiting this thing for $2 or $2.50, okay? Because basically what we're saying is, all right, we're just going to close our eyes to this position, wait till next week and see what happens. That's not good risk management, right? Even though we're in it for free, we still don't need to hit that grand slam. That is just not good risk management. If this thing starts trading 75, 80, 85 cents, that's a time to me where you start considering an exit, or at least at a minimum, putting in a stop exit. Okay, Suresh, welcome. Welcome to the room. This is Scott. We are at the end of a very, very long evaluation, long conversation about one of our butterfly positions. Please feel free to ask any questions at any time. We will all help you. Okay? Always lots of premium, David. Sure. Right, so that tells you the premium, Joe, right? Because we just went through this. So at 62, okay, at 62 here, if this were expiration, we're showing that the butterfly would be worth 0, right? However, today, the butterfly is still trading 40-ish or so. So yeah, listen, we could get out today and have hit a home run, right? We're in this for free. We're totally in this for free. However, holding on to this right now, again, to me, has a heck of a lot more upside potential than it does downside. Again, knowing how butterfly spreads trade. I'm willing to let this thing percolate and run a little bit, and willing to say, okay, maybe we get out at 30 cents if it starts going against us, rather than getting out now when certainly I believe the upside of getting this thing getting to 60, 70, 80 is far greater than that downside. And to me, that's not being piggish, right? That's not being, you know, the saying bulls and bears prosper, pigs go to the slaughter. That's not being piggish. That's just being in a situation of managing your risk wisely. Again, it's not very often, right, that we ever get a 100% free position where you just cannot lose no matter what. Not often that happens. Okay, David, let me put that up on the screen. Let's evaluate that. Okay, hang on. Let me save this thing here, and I'll post this up in the room. Let me save this first. Okay, this is the CREE call butterfly P&L example 40819. You can't, Jules? Could you have said the same thing on the upside? Could you have said that you couldn't see the stock going up $2 in 5 days? I'm just asking. Okay, and if we truly look at what the market is expecting in CREE over the next almost 2 weeks or week and a half until expiration, the market expected move right now is still about $2.80. Right? So I don't, that's a lesson. Sure, people definitely trade on their gut. They trade on their instincts. They trade on their own evaluations, right? But I'm looking at the best data that I can go with is what is the market telling me, right? So I don't have to make my own decision. What is the market telling me? Right now, options are pricing into the marketplace that CREE is going to have a range of about $2.80 between now and expiration. We don't know what direction that is. I'm willing to hold out a little bit here and see what happens. Okay, so David, let's get this up on the board here. Okay, and first off, we can see right now, the midpoint, again, that mark, that midpoint, whatever you want to call it, is 45 cents. We're going to say this thing is readily trading at 40, because that's where I truly believe this is trading. Okay? We know we're short delta, which is a good thing. Okay? So if David's asking, what would the theoretical value be if the stock went to 59.5 today? So down $2.50 today. Well, if we look at it just from a delta standpoint, okay, just from a delta standpoint, we would take the 12 delta times 2.5, and that would be a change of about 30 cents, right? Or making this, let's call it mark, theoretical value, whatever you want to call it, about 70 cents. Everybody following my math there? But I'm going to plot it out here. We're going to see exactly what it is, because it's not going to be 70 cents because, remember, the deltas change with the stock price. Okay, so now let's put this up here. And it's not far off from that 30 cents, but it's not quite 30 cents. So what we want to do is clear for everybody to see here. Okay, at 59.5, David, today, the value of this goes up by about 22 cents. So we're looking, somewhere, my guess would be 60 to 65 cents. And again, from this graph here, guys, here's another, let's call it proof point. Okay, we're short delta. Where do we see profitability come in? The green, as the stock is going down. For short delta, we want the stock to go down. Right? Any way we slice it here, a good thing. Any way we slice it, we're kind of getting to the same conclusion with delta and with profitability. And it better be that way, otherwise the whole thing gets thrown out the window. Okay, and this, the more and more you get to learn this, and this is deep stuff that we're talking about today, right? how you have these relationships between profitability, delta, the Greeks, time. That's not something you learn overnight. However, you can maybe start to see that option theory and option pricing, it's all kind of, I don't want to say a vicious circle, but it's all interconnected. Everything is interconnected. All right, any other questions here, guys? Otherwise, I'm going to wrap this up. This is definitely going to take a while to get the this video rendered here. Raymond, not right now. I mean, I'll tell you real quickly. A butterfly like this that has symmetrical strikes, meaning the difference, the width between the long part of the spread and the short part of the spread is the same, like it is in this instance. They're $2.50 wide, okay, is considered a neutral trade. It's really a delta neutral trade, okay? However, in a broken wing, yes, exactly. One of the two spreads has a different width than the other. So here we have $2.50 wide spreads. We have a long $2.50 wide call spread and a short $2.50 wide call spread. In an example of a broken wing, you may have a $5 wide long spread and maybe a $2.50 wide short spread. So that the delta of, like you just said, the delta of one of those legs is different. And that's what gives you that directional bias. Ultimately, you still want to have the same outcome. Ultimately, you still want the stock to go to the short strike. It's just a matter of the delta working faster or at a greater impact. But ultimately, you still want the stock to go to the short strike. Okay, everybody get that? Hi there, gents. You got a solution for that? It's over the last 2 years, like daily, it kind of, it's kind of like the glaciers every day. I think it's stable in the wall. It's something on the bracket that's causing it to tilt. So I think it's stable in the wall. Sorry, guys, we're looking through, looking at adjusting my TV on the wall here. So. Todd, we do catalog these, but I like that. I like that. That's a great idea. You know what? I am definitely going to do that. All right, guys, I'm going to sign off here and get this in the room. Thanks for all your patience.